Dear students, so today we are going to talk about another indicators from technical analysis, and we're going through two types of indicators. One is going to be the average true range, and the other one is going to be an average directional index, ATR and ADX. So both of these indicators are made or introduced by Wells Wilder from 1978. Both of you know him from at least from the previous lecture. And if not, then read his article from 1978, where he introduced several indicators including parabolic stop and reverse, ADR, ADX, and accumulation distribution line, and so on. Okay, what are we going to talk about today is, first of all, the ATR, average true range, and then we go through the average directional index, which is a pretty awesome indicator. So first, the ATR. ATR is an indicator that was constructed by Wilder with the intention to capture the volatility of the market. So that's the basic idea. What this true range actually is doing. So it's trying to capture the volatility of the market based on the differences between the current high and low prices and the previous ones. So it really doesn't really the indicator is not really taking into consideration whether the market is going up or down. All it's actually doing is just it's capturing the volatility. So the volatility can go up even in a downtrend. So you have to be really careful how you're going to interpret the ATR value. So you have to know how it's constructed. Okay, next information. It's not a real indicator because again you can't really do any kind of trading using a single ATR value. So it's going to reveal you some more information about the market, or it's going to support your decision or support other types of indicators that are actually giving you signals for trading. ATR is not giving signals for trading, but it has an immersion value for the trader to identify how strong the volatility of the market is, so you can at least know that if some kind of momentum indicator has indicated a change in the momentum and that momentum change is supported by a strong ATR value, then it's probably a good option to deal with. Okay, so it's not a real indicator in the meaning of indicator suitable for entering a position. ATR actually, at least his part, the true range part, is many times a part of calculations of other indicators. We are going to see even for the ADX, and there are plenty of other indicators that are actually using the true range, or they are even using the ATR values to calculate something. So the true range, as Waller describes it, is sort of an average price range in your period that you are looking at. Usually Wilder using 14 periods of exponential moving average, so he's looking at 14 close prices over days. And what you can at least judge from the ATR values. So if the ATR values are high, that means that the volatility of the market is also high. Ooh, such surprising information. If the values of ATR are low, also the volatility of the market is low, or at least is somewhere low, because in this 14, basically in this 14-day development, that's the result. Okay. The second information is if the ATR values are high, like really high compared to the previous development, you can probably be quite sure that some kind of momentum change in the market is going to happen shortly. So you have to watch carefully for ATR high values, because then they can signal you that there can be a potential momentum change in the market, or at least a change in the trend. So let's go to the calculation. So average true range, the word average, I think you understand. That exponential moving average of the period of 14. Basically, that was introduced by Volkswagen. Somehow it's going to smoothen up the true range values. Okay, so what are these true range values? The calculation is really basic. All you have to do is you have to get a maximum value, one of these three values. So you have to compare today high minus today low, and you get a value. What is really important here, all we are talking about is absolute values. So only the absolute difference between these values we are looking at. So we don't care about if it's a negative value. All the negative values are with those absolute words going to be turned into a positive value. So what we are looking for is only an absolute difference between these two values. Second option is today high minus previous close. The last option is today low minus the previous close. The first option, you can quite easily eliminate the options when you are able to use it. It's so-called outside days. So that means an outside day is when the whole range, so the high and the low, is like wrapping over the previous candle. So the previous day you could literally trade inside the whole day. You could trade literally inside the current day. So that's an outside day. So the today current day would be an outside day. Only in this case it makes sense to use the method number one, because in all the other cases the today high minus today low won't be the highest value about among these three. That's quite basic principle of mathematics. Okay, so second option, today high minus previous close. So you're comparing the current high minus the yesterday's close, and then you get today low minus previous close. So if it's a positive day, you can get quite a high value, but if the volatility was increasing in a downtrend, maybe the third thing is even bigger. So actually we don't care about if it's up or down, we just care about the value. So we just care about the volatility like it is described. Okay, so the TR, true range, is the maximum value of these three values. Then ATR is the average from these maximum values. Usually Wilder is using the 14 period exponential moving average to get it. Okay, so ATR indicator is universal. It can be applied to any kind of market, even the commodity market, up to the forex, up to the cryptocurrencies, whatever. And you can also use it to identify where your stop loss should be treated, so it's on the peaks and roots and so on. Okay, so now the method selection. So the method one is for the outside day. Oh, sorry, partially Slovak. So method one is for the outside day. Current high is above the previous one, and the current low is below the previous one. That's quite simple. I can't describe it more easily. Wait a second. I'll probably have a picture. Yes. Okay. So here, this is a typical outside day. So I can fit the previous day inside the range of today. So the current high is above the high of previous day, and the current low is lower than the previous low. That's an outside day. This is not an outside day, not an outside day, not an outside day, not an outside day. You got my point, yeah? No other outside days are here, because this low is here. No, this is the only outside day. Okay, understood? Quite easy. So let's select let's check the other options. So the method 2 and 3 are suitable for the other situations when, for example, this can happen. So let's see these 3 days as ABC. So day A, we should take the maximum value from the difference between the current high and the previous close, which is this green line over here, and compare it to the current low minus previous close, which is only that part of the line. Which of these two lines is longer? It's the first one, so we got a TR value in day A. Let's go to day B. Again, we should compare the current high with the previous close. It's that line over here. Yeah. To the current low minus the previous close, which is that green line over here. Which of these two values is greater? For sure it's the one. Why does it make sense to compare high and low? Because it's only that small part over here. It's never gonna happen. Okay, the C day, same trick. Current high minus previous close. Is that part? Current low minus previous close. It's only that small part over here. Which of these two numbers is bigger? I think you got the point. Okay. So, average true range in practical point of view. So how this ATR looks like. We know that if we got the true range values, it's an absolute value from as a maximum from these three numbers. So always it's going to be a positive value. So for sure the true range values are going to be some positive numbers. If you make an average of positive numbers, you will always get a positive number. So it can't happen that you will go and see negative ATR values unless it's not a usual ATR indicator. It has to be some modification. So it's an off price chart indicator, because the epsilon axis is way different from the epsilon axis of the price. And how it looks like? It looks like one line that usually it's tilted left. So like a right-hander would be drawing this line tilted left. I will show you another example. And this line either goes up or down or stays at some level. So let's have a look. For example, on the market, I can clearly see a side trend here. At least side movement, sorry, no side trend. Side trend doesn't exist. So side movement of the market, like no trend day. And the ATR value is also not moving, but a little bit decreasing. So the volatility looks like it's changing and even decreasing. So because these waves are like eliminating each other. Okay. After that, a small peak in the ATR value is visible. That means that small increase over here, this gap probably is corresponding to this peak. These empty candles back here. And then, if you can see, the development is quite really stable. So also the volatility, except these small corrections over here, is not moving much, and over here is also like really stable. So the ATR is following that, no big deal. And then the volatility is even decreasing over here. Also the ATR value is showing that stagnation, nothing's going to happen. And only that small part over here is then showing you some kind of development over here. Just a small increase, and then this huge candle down here, that's where this huge peak in ATR is corresponding here. And then again, nothing on the market. So you can see with the high volatility, high changes on the market and price, also the ATR value is changing rapidly. Okay, let's have a look. For example, stock chart. Not stock chart, trading view for an ATR. Okay, so I have Apple and I'm showing the ATR value. You can see it's like left tilted writings. This is how ATR usually looks like in an uptrend. So you can see the market is tilted right, and this looks like it's tilted left. And again, okay, so you can see it's a downtrend and increasing the ATR. Why? Because it's only measuring the volatility. It doesn't have to do anything with the trend or with the direction of the movement on the market. So again, increasing volatility. Why? Because of these gaps over here. It's like sharply going down all the way until here. Then it's a little bit slowing down, and here is the reversal point, also supported by a little strengthening in ATR. And then again, this uptrend is now stable after the positive information from the earnings. And so the volatility is even decreasing because there is almost no movement on the market. The candles are sticking together, creating almost a line in here and even in here. Only these peaks over here are creating a mess, and then these huge gaps in here, and so on. So you can see how the volatility is changing when you are looking on the ATR value. Okay, and what for is it good to me for me? So if I'm using a momentum indicator and a combination with ATR, I can judge probably if the momentum is coming, a change in the momentum is coming, and if the momentum indicator is telling me that a change is coming and it's supported by a strong ATR, usually the momentum indicator can be right, and you should be able to learn from the situation and to accommodate yourself with your trading strategy. Okay, so some pros and cons of ATR. Turnovers, so changes in momentum supported by strong ATR, usually are a significant change on the market. But ATR has also seen his downs. For example, it's an absolute value, so you can't compare. So if you're looking on a stock with high values, you will get high ATRs, and if you're comparing to, for example, as I had for Amazon, its ranges in dollars, then you probably are not able to compare these two stocks ATRs. So that's not really good. Okay, I'll mention you that the TR is a part of another indicator. So let's follow our lecture and let's talk about ADX, which is also an indicator from the pen of Wells Fargo from 1978. This indicator is called Average Directional Index. This indicator is pretty cool because this indicator is telling you something about the trend. Actually, it's an oscillator. It's a range oscillator. It has lower boundary and the upper boundary, and we are going to look for some levels that are really interesting for us. At least they were for Wells Fargo, to introduce them as the mechanism how the ADX is actually going to be used. The main idea of ADX is not to give you a tool for trading in the normal common sense, but it's an indicator to define the trend path. So actually what you can do with ADX is you can guess how strong the trend currently on the market is. Again, I'm talking about the strength of the trend, not about its direction. That's also a completely different thing. So which are these levels that we are looking for or we should be taking care about? So it's when the ADX indicator is having the values below 20, we can say that the market is not trending or there is a very weak trend on the market. Values about 40, there we are talking about strong trending market, and sometimes the values can go even through 60 or above 60. That's very rare. You will see it's not that rare, but yeah, it happens. It depends on the volatility of stocks. Again, increase in ADX doesn't mean that the market is strong rising or strong uptrend. All it does say is that the strength of the trend currently on the market is increasing. So rising ADX is just telling you that the strength of the trend is increasing, not that the actual trend is an uprising or uptrend, And a decline in ADX doesn't mean that it's a downtrend on the market. It's just weakening. The trend on the market is weakening. Even an uptrend can be weakening and the ADX is going down. Okay, so ADX is actually created from two other indicators, his partial indicators. They are really important because now comes the direction in, and these two indicators are positive directional indicator and negative directional indicator. The positive one we usually mark it as plus DI and minus DI. Also, on the chart they have different colors. Okay, so what is the plus di and minus di? So now, only now, when looking on the plus di and minus di, we can guess or judge if the trend is an increasing or decreasing trend. So ADX is telling you the strength, and only his partial indicators plus di and minus di are telling you the direction of the trend. So the plus di is representing the power of growing or increasing uptrend. Minus di is representing the power of decreasing downtrend. Calculation of directional indicators. Plus di and minus di. Plus di is something that we call direction movement divided by true range. Again, the plus directional movement, it means you take the current high minus previous high compared to previous low minus current low. That's the way how you get a directional movement. If you get a negative value out of this, you write simple 0. The minus di, you just swap the current, the previous high minus current high, and you again, if you got a negative value, you just swap it for a 0. So actually there is no going to be no negative values from the plus dm and minus dm from both of the directional movements for the periods. You already know that the true range is going to be all the time a positive value. So all you are going to do is you are going to divide some kind of positive value divided by some kind of positive value, or it's a 0 divided by positive values. And again, for the minus di, it goes the same. You're also going to kick all the negative values and replace them by 0, and you only take the positive differences. So all you get is you get two lines, plus di, minus di. They are going to be always 0 or at least 0 and positive. They are going to increase or decrease. And now for interpretation. If the value ADX crosses the level 20 from the bottom to up, so upwards, that means it was oscillating below 20, showing you no trend, and then it crosses the 20 upwards, probably there somewhere can be the beginning of a new trend. How strong the new trend is going to be, you can guess from your experience and basically from the angle that the ADX line is going to have with the level of 20, or how sharp the entry into the range is. On the other hand, if the value ADX is above 40 and then it crosses the 40 downwards, there probably is the end of the trend. Also quite simple. So again, end of the trend when it crosses 40 down, beginning of the trend when the crosses 20 from upwards. So in the ranges between 20 and 40, there is a shadow space where you can't really guess how strong actually the trend is going to be in the end. So if the ADX is oscillating there, so modest trend is on the market, usually with some kind of side movement and so on. Okay, partial indicators and how we can use them. Now comes the trick. You can identify an uptrend using the plus di and minus di when the plus di is increasing and minus di is decreasing. So one line is going up and the other one is going down, or at least it's not rising, so it's like staying at 0. Now carefully, a downtrend is again now when the minus di is dominating the plus di. So it means when the minus di is increasing and the plus di is decreasing. So here I'll be careful because usually that's where you do mistakes at the exam. You say if plus di increases and minus di decreases, that's an uptrend, and if minus di decreases and plus di increases, it's the downtrend. No, it's the same. It means if one of these two indicators is dominating the other one, so it's increasing above or increasing or just increasing, and the other one is decreasing. That means if plus di is increasing, uptrend. If minus di is increasing, downtrend, and the other one has to be decreasing. Okay. If the plus di is above minus di, bullish traders are dominant on the market. and opposite situation is when the minus di is about plus di. Okay, now let's have a look. We have a Google same charts like we had for the ATR, and down there you can see an ADX with a typical 14 period. So all it did, it added together um, um, plus di minus di and did an average of 14, and it was created this line. And then we are looking for the level 20 and 40. You can see it's an oscillator with 0 and something positive. That something is 100. But usually we don't need it in this period. Highest values are 45 or something like that. Okay, so interpretation. If the ADX is below 20, no trend on the market. Crossing the line from 20 line from below, here could be a beginning of a new trend. But the ADX didn't rise enough and it stayed in below 20, below 30, so no big deal, and then returned back into into the level below 20. Actually, on the market there is no trend; it's only side movement, a correction from a downtrend that was identified as a new trend. ADX fooled you. He thought this is going to be a beginning of a new trend, but it didn't happen. Then again, the ADX went way below 20, showing you, yes, there is no trend on the market. These waves are like eliminating each other, so that's why even the ADX is going down. And a new trend was identified here in July, somewhere here, as a quite sharp increase in ADX, still increasing, so giving you the information, yes, the trend is strengthening on the market. And if you're looking on other trend indicators, you can see it's an uptrend, so yes, strengthening market showing in ADX, and an uptrend I can read from the price chart. Again, ADX went about 40, then it crossed the 40 way on its way down here, showing you that it's the end of the trend. But currently it also didn't cross the 30 line and stayed somewhere close to it, and even increased above it again, showing you again a strong trend on the market, and then quite sharp going down, showing you that okay, over here you should be considering that yes, it's probably the end of the trend, or at least some kind of turnover. Okay, and again, side movement showing you almost no trend. Now, if we add these two components of ADX, the plus DI and minus DI, into consideration, then we'll get something like that. So we see ADX, black line in the middle, and plus DI and minus DI are these lines over here. So again, these lines are showing you which of the traders are dominating the market, and if the plus DI is increasing and the minus DI is decreasing, it means there is an uptrend. So again, uptrend is identified over here. Okay, so plus DI increasing it means uptrend when also the minus DI is decreasing. Opposite situation, minus DI is increasing, plus DI is decreasing, downtrend. Not strong, not so strong, but quite sharp increase. Blue line about red line, green line about red line, dominated, market dominated by buyers. Red line about green line, market dominated by sellers. And basically that's it. That's it how you can use average directional index in your favor using its components plus DI and minus DI. So again, quite easy. Application is not that complicated. Be careful where are you going to use it and how you are going to interpret ADX, strength of the market, and plus DI minus DI. That's the directional movement. So there you can talk about uptrend and downtrend and how strong is it, guessing from the ADX. Again, it's only some kind of probability. Also the indicator is going to fool you around like you saw in my examples. So again, you have to be combining some kind of indicators together. Not every trade is going to be a success unless you use your own expertise in it. Okay, thank you for your attention. See you next week.